The next few slides are simply an effort to make the connection between the interest rate and the money supply. We talked about the money supply decision, talked about the interest rate decision. There is a connection between the two. And you can illustrate that connection with a very simple idea of money demand. And money demand is just a connection between the interest rate and the amount of money in the economy. Basically, the idea is people will hold more money, as I just defined it, say currency, in their wallet if interest rates are low than if they're high. Because if interest rates are high, you can put your money in a savings account. It's the opportunity cost of holding money in your wallet or your purse is much higher. So there's this negative relationship between money and the interest rate. And that's what that is. That's what that says. Is that you always have to think about a comparison of two things. In this case, money, which doesn't pay interest, and the alternative asset, which does. So that creates this idea of a money demand. If you remember what I just said about the money supply, then you have a answer to the question is how did the Fed determine interest rate in principle? So there's the money demand. That's just what I said a few minutes ago. The higher the interest rate is, the lower the quantity of money demanded. It's just like another demand curve. You'll study many of those in these next few days. If the Fed controls the supply, we just described how that happens, then it now can control the interest rate because it controls the intercept between supply and demand for money. Okay, so there's the interest rate. And then finally, it can change the amount of interest rate by altering the money supply. So money supply increases or decreases, and that affects the interest rate. So I'm just shifting the money supply back and forth along the money demand curve, and that changes the interest rate on the vertical axis. Okay, so that's how the Fed in principle controls the interest rate. Now it's gotten a little more difficult recently to do that because of something called the zero bound or effective lower bound interest rate. The Fed had the interest rate close to zero for quite a while until recently because it didn't think it could take the interest rate below zero. Actually, some central banks have actually done that. The European Central Bank is slightly below zero. The Bank of Japan is below zero. The Swiss National Bank is below zero, but they're not that much below zero. So there's a question, how does this work when the interest rate is zero? Well, you can see the problem. So more and more money, shifting the vertical line to the right, more supply of money. You go along the demand curve, and the interest rate doesn't fall below a certain point. So at some point, this interest rate is just constrained by the zero bound. And that has led to many different things. This is an illustration of from Bloomberg News, I believe, of the Taylor rule and the actual interest rate by the Fed. And so you can see the period over on the left. The horizontal scale is not great, but over on the left, that's the period of interest rates being too low for too long compared to the rule. And then you have this period over here where it hits the zero bound, according to this, and then it goes above somewhat. So that zero bound was a constraint. Maybe it was a constraint longer in this picture, but it was a constraint. And so how do we think about that in terms of monetary economics? The subject's gotten more and more complicated. We've dealt with that in the US and other countries in two ways. One is by the so-called forward guidance idea. So forward guidance is simply a way to tell the markets what the Fed or the other central banks will do in the future. It's a guided of the future, forward guidance. And it's happened in the past, and I'll show you some examples of that. And the rationale for it, you could probably consider this a little more in the boot camp. The rationale is that longer term interest rates, 2, 3, 4, 5 years, are to some extent dependent on what people think the short rate will be in the future. So if the Fed can promise a low short rate in the future, then it's going to reduce long rates today. That's the idea. So sometimes it's called this term structure of interest rate. A promise of low interest rate 5 years from now will lower long-term interest rates today. That's why forward guidance is viewed as a way to deal with the zero lower bound. It makes the interest rate, long rates, lower than otherwise. You can see examples of that. Oops, there's an example. This period where I mentioned they were below the policy rule, you can divide that into, they call it considerable period. the considerable period. That's where the Fed said it would hold the rate low for a considerable period. And then after the vertical line is when they started talking about they'll raise it as a measured pace. So they're signaling in a forward guidance sense what they're going to do. So this is a thing that central banks do a lot, but it's now become more common because of the zero bound. It's viewed as a way to deal with that, another wrinkle in monetary policy. And then the second wrinkle that they have done, and it brings back to the question of why they increase reserves so much, is the Fed has thought that by buying more and more bonds, they're able to drive the interest rate lower on longer term bonds, and that stimulates the economy. So even though the zero bound exists for the short rate, the federal funds rate, it doesn't exist for longer term treasuries. And so they figured, well, if we buy those, we'll be able to drive the interest rate down. And I'll show you that with this picture. Okay, so this is a little bit closer to what I showed you a few minutes ago. It's showing you reserve balances at the Fed. You know what that is at this point. You know that they were very low, a little teeny weeny blip in 9/11. I was in government in 9/11. That was not a teeny blip at the time, but now it looks so ridiculously small, $60 billion. Okay, anyway, so they started this quantitative easing, I'll call it Q1, Q2, and Q3, and each time they bought lots of bonds, they had to pay for it with these reserves. And there you see reserves going up, and then they stopped, and it's starting to come down at this point. And so the rationale is that they can drive the interest rate, the longer interest rate down. That was the rationale they used, and the rationale based on we have this zero bound. And so they're trying to undo it now, and that's where I want to segue for the last few minutes is what's happening now. Okay, okay, so what's happening now? A lot of people are worried about what the Fed and other central banks have done in the last few years. The quantitative ease and the forward guidance, the Great Recession itself, too low for too long, a lot of other things. It doesn't seem like monetary policy has worked very well. I mean, we had a terrible, terrible recession, hurt lots of people. To what extent that's related to monetary policy? So some people have said, well, let's make sure the Fed doesn't do this in the future. Let's have them state what their rule or strategy is. It's their job to say what it should be, but it's their job to say what it is. It's like a transparency. So there's legislation in the Congress calling on the Fed to report its strategy for its instruments. It's actually written into the bill. It's passed the House, hasn't passed the Senate. And it would require the Fed to describe the strategy or rule of the FOMC for the systematic quantitative adjustment of its federal funds rate or policy instrument. And again, the Fed would not be chained. It would decide what it wanted to do, but it had to tell the Congress and the public, more important, what it is. And so the hope is that that would create less of a tendency to have these large deviations from what at least I and others think doesn't work very well. The good news, in a sense, is maybe the Fed is moving in this direction already. And I want to kind of leave you with that idea and a few other things. Change may be on the way. So I think in some sense the Fed, and this began sometime last year, I believe, began to make some changes. And you can see it in speeches, publications, actions, and appointments to the central bank. And they began in 2017, and they continued in 2018. Oops. So these are a list, and you can get the slides here later if you want. But so this is kind of the documentation of my point. 2017, Janet Yellen, who was then the chair of the Fed, gave a speech in San Francisco describing the Fed's strategy, more than I've ever seen before. It may seem weak to you, but it's pretty strong. When the economy is weak, we encourage spending and invest by pushing short-term interest rates lower. When the economy is threatening to push inflation too high, down the road, we increase interest rates. That's a policy rule. Then she compared that in a speech just a day later with the Taylor rule and other rules and explained the differences. That's exactly what the legislation would want to have. Stanley Fischer, who was then vice chair of the Fed, gives the same kind of a speech actually at Warwick University in February of last year, And then the Fed began, for the first time ever, to publish a section of its annual monetary policy report, which had the title, Monetary Policy Rules and the Role in the Fed's Policy Process. So this has never been done before, and it began sometime last year. So it's a difference. You can think about what you might and why it was happening. A new chair was appointed by President Trump and confirmed to the Senate. And in his first monetary policy report, he has the same kind of a section of policy rules. And moreover, when he testifies in Congress for the first time in February or March of this year, he says, in evaluating the stance of monetary policy, the FOMC routinely consults monetary policy rules that connect prescriptions for the policy rate with variables associated with our mandated objectives. Personally, I find these prescriptions very useful. Larry Kudlow, who's now the director of the National Economic Council in the White House, this is before he was chosen for that job, he writes that this emphasis is amazing. I've never seen that in any testimony before. I think it's progress. In March of this year, the Fed has a new section of their website. I'd suggest taking a look at it. And in July, they again do this thing on monetary policy report. So those are speeches, testimony, appointments. So the new vice chair for supervision of the Fed, Randy Quarles, is a good friend, espoused rules-based policy for many, many years. The vice chair in waiting, Richard Clarida, very much someone who's thought about rules this way. And John Williams is a student of Stanford, a student of mine who's now just moved to the president of New York Fed, has the same attitude. So I think there's something going on here which is promising, even though the legislation is still in abeyance. Okay, so let me just finish off with a sense in which this whole issue is global. And I want to maybe just use this chart. The words are helpful, but the chart is more helpful. So this is a picture that the Bank for International Settlements has produced, which compares policy interest rates around the world to the Taylor rule. And it says mean Taylor rate. Doesn't mean mean. It means it's an average Taylor rate, okay? And so what they've done is taken the average interest rate in the world, that's on the left, global, and emerging markets on the right. And the red line is the policy rate, and the blue line is what the rule would say. So you can see globally, this too low for too long period happened in 03, 04, 05. Then the central banks did a good job, along with the Fed, during the Great Recession, 2008, but then they deviated again. So there's a global aspect to this phenomenon, and you can see it if you just look at central banks or you talk to them like I do. And one reason it's happened is because they tend to follow each other. And there's many reasons why they do, but perhaps the most important has to do with exchange rates. And I want to just give you a couple charts to illustrate how this happens, what I think it happens. And so again, what this means that for some reason, when the Fed cuts rates, other central banks cut rates. Not one-to-one, not exactly, but to some extent. It means when the Fed does quantitative easing, other central banks do quantitative easing. Not one-to-one, but there's a connection. And I think that's a problem, especially if you think the policy is getting off track in the US. So we need to fix that. And so here's the charts I want to just illustrate this with you. This is the exchange rate between the dollar and the yen. So it's yen per dollar on the vertical axis. And the time period is 07 till pretty close to the present. And you can see, in this case, the dollar is depreciating up until around 2011, 2012. The yen is appreciating from 120 to 80 yen per dollar. The yen is very strong. Abe runs for election. He becomes the prime minister. One of his planks is the yen's too strong. He appoints Haruhiko Kuroda to be the governor of the Bank of Japan. He says, go for it. We need quantitative easing. He does, and you can see the exchange rate moves. The yen depreciates enormously. And so that's the connection, we think. This is Europe. So this is the dollar-euro exchange rate. And the date August 2014 is mentioned here because in August 2014, Mario Draghi gives a speech in Jackson Hole, Wyoming. There's a conference there on monetary policy every summer. There's one coming up later this week I'm going to. Jay Powell will speak. But in 2014, Mario Draghi spoke, and he said, the euro's too high. We've got to do something about it. So they began their quantitative easing. And those of you who follow monetary policy in Europe know that. And of course, that moved the dollar, the euro down relative to the dollar. So that's the connection that I'm emphasizing here. And I think that connection is one of the reasons why these even large central banks tend to move together. Now, what that suggests, of course, is that the move by the Fed, which I've shown is beginning to happen, and they've got their interest rate at 2%, and it looks like it's going to go maybe above 3.25, 3.5. That's what they're signaling. That should bring about a change in the other central banks. In fact, there's already some evidence that Europe is beginning to adjust. Europe has stopped the increase in quantitative easing. Japan is not there yet. And I think that will make other central banks around the world possible in that direction. So in some sense, there's the reform that we're beginning to see, I hope, in the US is something that could occur more globally. And it's not like central bankers don't want this to happen. So Paul Volcker, I showed you his picture on the cover of Time magazine. He's writing relatively recently, the absence of an official rules-based cooperatively managed system has not been a great success. Raghu Rajan, who until recently the governor of the Reserve Bank of India, what we need are monetary rules that prevent a central bank's domestic mandate from trumping a country's international responsibility. And Mario Draghi himself is saying we should improve communications over our reaction functions, which is our rules. So I think this is something central banks would like to happen. And my idea is based on what I've tried to say already, is you could do this if all central banks became more rule-like. And so the specific proposal, which I've talked about many times in the last year, is each central bank should describe and commit to a monetary policy strategy for the policy instruments. It may be the Fed's moving in that direction. I've given you some indication, not widely discussed, but it's in the record, in speeches and appointments about that. There are calls for reform, that I mentioned some of them already, so maybe now might be the good time. And how to reform is still being debated, but in some sense, it does seem to me to say that the rules I've described are better, and when we've gone off it, it's been terrible. That Great Recession is unbelievable. What an embarrassment. What a tragedy we had. And if it's any related to monetary policy, we should try to prevent it from happening. So monetary policy's work and discretion doesn't, and I have some time for questions.